Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The quartile level of 369 has been largely important for July corn for quite some time. This market has oscillated up and down either side of this about the same distance each time, touching about 380 above and near 360 below. As it continues to oscillate across this price level, a clear break of either side needs to happen fairly quickly. We continue to have very good support up against 367. As long as we close above 372 this week, we continue to be confident that the upside is in the future for corn. Right now, because it's been taking so long for the market to take off, reaching 400 may be a bit muted, although moving up to about 390 still continues to be realistic. Near that 369 number that we spoke of, we have our point of control at 372, and that's right about where the market is trading right now. The lows that were made prior to the 360 low came in near 365 or so, and so the recent lows that we're seeing are above the previous lows, which is a very good indication as far as this head and shoulders formation is concerned. So as long as this market again is able to close above 372 this week, we continue to be optimistic to the upside potential of its movement. In the event that we're able to close above 375 this week, that would give us greater confidence in the capacity for this contract to reach 400 before coming off the board, potentially in the middle of June. So right now, our key levels that we continue to look at would be the 365 half and 375 for the key demarcation levels for this contract. As can be seen here, our sinusoidal wave is now starting to make its way up, which could very well be an indication of upward potential for this contract as it continues to trace up against this sinusoidal wave support line. On the December contract, we see a similar formation, whereas we can see sequential higher lows now actually hitting the market, with a higher double bottom being the most recent pattern that we're now seeing. Given this formation then, if this market's able to close above 390 this week, we believe that a potential fast move to the upside could very well be underway, where we can see this market touching somewhere in the neighborhood of 400 sometime next week. The key level that we would be looking for would be a close above 390 this week. Support appears to have been very strong up against 382 3/4, which is our 180-degree mark. 45 degrees above that, we have 392 half, and once the market's able to clear 392 half, we again feel fairly confident that reaching 400 is very possible. We also have volatility-based resistance overhead in the 400 to 405 area, and so once this market gets here, we would not be surprised to see the market move a bit sideways upon hitting this region, but from there, continued strength is also plausible. Per our analysis last week, we shared that 960 would be the key level for the soybean contract. 960 half was the low that was reached on Friday, and from there the market has been edging its way higher over the last 3 trading days. So this key level of 960 appears to have been very important as we suggested, and as long as this market remains above this 960 number, we believe a continued move to the upside, possibly through the month of June, is possible. Right now, we have a point of control level that sits at 975 3/4, and this is going to be the key level that we look to this week for this market to close above in terms of the probability of continued upside strength. Once this market is able to firmly clear 975, 976, then the next key target we would be looking at is the $10 mark. So for now, the market continues to make higher highs and higher lows, and so we'll simply continue to track the market as it makes these levels, look for potential entries at pullbacks, but for this week, the 976 level is going to be the key area to watch. Upon getting through 976, the major area of resistance that we would next be looking to is 983.5. And then once the market's able to get through there, as mentioned before, the $10 mark is going to be really good resistance. We also have volatility-based resistance sitting right at that level between the $10 and $10.11 mark. And so again, we anticipate that once this market gets to this region, the $10 mark will be of significance, especially since we're sitting at a sinusoidal wave number that coincides with that volatility-based resistance band as well. As would be expected, the November contract for beans has a similar formation. For him, the 973 level is going to be the key area that we look to this week. And upon breaking 973, in a similar fashion, we would look for this market to make its way up to about $10 over the course of the next couple of weeks. Its first approach to volatility-based resistance tagged right up against 980, from which the market has since dropped and has been consolidating for the following 5 to 8 trading days or so. From here then, if the market is able to make its way back up and retest, we anticipate that the market could very well break through, and from here we would be looking at upside targets of about 996. July wheat found support at the 78.6 support level at 425.75, but that was only briefly. The market moved up about 2 or 3 days from there, came back down, and actually broke through that 425.75 number, making a low somewhere near 420, but has since reversed back up again. It is still possible that we can see a marginal break of the previous lows that were at 416, but for now the market is oversold. So from here, we are still in play for a potential move to the upside. And as we'll see later, the dollar continues to find weakness, which perhaps may make a case for wheat finding some support here. The primary obstacle ahead for this contract is the 440.75 level. And once this market is able to get above this 441 region, then that would be an indication of potential clear sailing for it to retest overhead resistance in the neighborhood of 455 to 462. And so for this contract, we look at that 441 number as the level of key importance to have on our radar over the course of the next week or two. The December contract is moving very much in concert. In a similar fashion, it broke down below 463.25, has dropped below and has since reversed back up again, is now back above that level. We anticipate that getting above 470 would be of significance. And once it's able to do that, we would look for the market to perhaps approach its point of control, which sits at 42.5. At the 90-degree mark, we have 475.5, which is very close to that 470 number that we just discussed a second ago. And once this market is able to clear 474.5, that should be clear sailing for it to make a run for volatility-based resistance overhead in the neighborhood of 45.5, potentially as high as 496. Here we have a snapshot of the US dollar where it made a major high back in December/January. And from there, we've had 3 sequential lower highs coming in. These sequential lower highs were of great significance, and when markets cascade down in this fashion, it is not uncommon to see a very big move to the downside after that 3rd or 4th sequential lower high. That's exactly what we're experiencing right now. As we can see, the dollar is making a very big break to the downside. Now, the levels that we have before us tell us where the market may find some potential support. Through here, the market has now dropped all the way down to that 97.67 area that we had marked off for quite some time. Once the market gets through here, we would be looking at either touching volatility-based support or even getting down as low as our 360-degree mark near 95.82 before it finds really good support to bounce off from. The market is not quite oversold as of yet, so the potential for downside still exists. It's hitting up against our volatility band, so we may see a slow pause, but the downside looks like it should continue, especially given the sequential lower highs that we indicated earlier. The weakness in the dollar then bodes as potential strength for the commodities, so we'll continue to track the progress of the US dollar and its implication in the other commodities. Last week, we introduced a bonus chart, the December cotton contract, where we showed that the market looked to potentially move higher if it were able to hold support. The market came in and did touch one of our support levels at 72.27. This is where the market found excellent support and has since bounced up from there. We had previously discussed areas where the market could come in and find support near 71.63 and possibly down to 71.35 as a potential fade. The market did not get quite that weak when it came in and actually became oversold. It has since bounced up from that level and looks to be quickly approaching our minimum price objective of 76.64. And so for those who took advantage of potentially buying on a buyer's bar on the market, as we discussed previously, should be sitting on a trade that appears to be profitable, where you could move your stops from previous lows to break even or just above entry, and trailing your stop up as we look to make a run to that 76.64 target that we discussed. In closing, we'll have a look at the crude oil contract. As mentioned previously, we thought that a significant low was made in crude oil and that the market was poised to actually start making its way back up again. And as we can see here, the market has been steadily making its way up after having been oversold. It's now sitting up against resistance near our 180-degree mark, and it first tested this level back on Monday, gave us an inside bar, and is again testing it again. If we close above this 49.21 mark this week, we would not be surprised to see the market continue to make a run that looks to test somewhere in the neighborhood of $51 to $52. From there, we can see a pullback come in or a slight pause in this move to the upside. But as we suggested before, this market has made a significant low, and look for dips to buy into for the market to continue to creep back up again potentially. Thank you so much for joining us for our weekly market update, and look forward to touching base with you again next week.